Let me ask you a question before we begin. When the world was shouting, trade war. When headlines were full of tariffs, fear, and economic uncertainty, why did the smartest money on earth quietly move in the opposite direction? Welcome. Today we are going to uncover a story that most people never looked at deeply. A story of power strategy and long-term vision. This is the story of why BlackRock, JP Morgan, and Goldman Sachs moved $1.39 trillion into China during Donald Trump's trade war. Ladies and gentlemen, markets do not move on emotions. Nations argue on television, but capital moves in silence. While the media was busy showing conflict between the United States and China, the biggest financial institutions in the world were reading a different script. They were not listening to speeches. They were reading balance sheets, demographics, supply chains, and future dominance. And what they saw made them act boldly. Here is the first truth you must understand. Trade wars are not about stopping business. They are about reshaping it. Tariffs create fear for small investors, but they create discounts for giants. When tariffs hit, Chinese companies' valuations dropped, confidence weakened, and uncertainty spread. For ordinary people, this looked dangerous. For BlackRock, JP Morgan, and Goldman Sachs, this looked like opportunity knocking loudly. China was not collapsing. China was recalibrating. During the trade war, China accelerated internal consumption, invested heavily in technology, artificial intelligence, electric vehicles, and advanced manufacturing. It opened parts of its financial markets to foreign capital for the first time in history. Wall Street saw access where others saw risk. They understood that short-term pain was buying long-term control. Let me give you a powerful hook to think about. Money does not follow flags. Money follows future cash flow. These institutions knew that China still had the world's largest manufacturing ecosystem, a rising middle class, larger than the population of most continents, and a government willing to protect long-term growth at any cost. Tariffs could slow trade, but they could not erase 20 years of infrastructure, data, and human capital. Another critical factor was diversification. During the trade war, U.S. markets were highly volatile, politics was unpredictable, and interest rates were under pressure. China offered something rare: scale growth and policy direction. By moving capital into Chinese bonds, equities, and joint ventures, these firms were hedging against American uncertainty. This was not betrayal. This was survival at the highest level of finance. Now listen carefully, because this part is important. These moves were not impulsive. They were strategic. BlackRock launched China-focused funds. JP Morgan increased its ownership in Chinese securities businesses. Goldman Sachs expanded underwriting and advisory operations inside China. This was not a reaction to Trump. This was preparation for a post-Trump world. Here is the mindset lesson for all of us. Winners think in decades, not headlines. While politicians fight elections, investors fight for generations. The trade war was temporary. China's role in the global economy was structural. Smart money always chooses structure over noise. So what does this mean for you and me? It means never confuse loud conflict with real decline. It means when fear dominates, the news opportunity often hides behind it. And it means that understanding economics is not about choosing sides, but about reading direction. As I close, let me leave you with this final thought. While nations argue, power is being redistributed silently through capital flows. $1.39 trillion did not move to China by accident. It moved because the future was being priced in early. Learn to think like institutions, not crowds. Learn to see beyond today's fear into tomorrow's advantage. Because in the world of economics, those who see first lead later. When most people hear political speeches about trade wars, they assume capital will automatically retreat. But history shows something very different. Capital does not respond to emotion, slogans, or election cycles. It responds to fundamentals. This is the first hook you must understand. Markets may panic for weeks, but institutions plan for decades. During the US-China trade war, the loudest voices were political, yet the strongest signals were economic. While public attention focused on tariffs and retaliation, long-term indicators inside China continued to point towards stability, scale, and future cash generation. China's economic foundation was not built overnight, and it was not undone by tariffs. It rested on deeply integrated supply chains, world-class infrastructure, and a manufacturing ecosystem that no other economy could replicate at the same scale and speed. Even as trade tensions rose, China remained central to global production networks, from electronics to pharmaceuticals to renewable energy components. For institutional investors, this was not a weakness but a moat. You do not abandon the factory of the world because of temporary friction. You position yourself closer to it. Another powerful hook lies in demographics and demand. China's rising middle class represented hundreds of millions of consumers moving into higher income brackets. Consumption growth inside China was increasingly driven by domestic demand rather than exports alone. This shift reduced dependence on U.S. markets and increased resilience against external shocks. Investors understood that tariffs could slow trade flows, but they could not erase a population with growing purchasing power, urbanization momentum, and long-term consumption expansion. Policy direction mattered just as much as size. Unlike systems driven by short-term political cycles, China's economic planning operated on long-range objectives. Industrial upgrading, technology self-sufficiency, artificial intelligence, electric vehicles, and green energy were not campaign promises but state-backed priorities with capital support behind them. For global financial institutions, this provided clarity. When direction is clear, risk becomes measurable. And when risk becomes measurable, capital becomes confident. Currency and bond market dynamics added another layer of attraction. Chinese government bonds offered yields that were often higher than comparable developed market bonds, while maintaining relative stability. As global interest rates fluctuated and U.S. fiscal uncertainty grew, China's fixed income market began to look less like an emerging risk and more like a strategic anchor. Large institutions do not chase yield blindly. They balance return, stability, and correlation. China fit that equation during the trade war period. Here is the deeper insight most people miss. Political conflict can actually sharpen economic fundamentals by forcing adaptation. The trade war accelerated China's push towards self-reliance, innovation, and internal efficiency. What looked like pressure from the outside became reform momentum on the inside. Smart money recognized that adaptation increases long-term strength. Instead of seeing vulnerability, institutions saw evolution in real time. This is why capital flows ignored the noise. Money followed infrastructure that was already built, consumers who were already rising, and policies that were already funded. Headlines changed weekly, but balance sheets told a consistent story. Those who understood fundamentals saw opportunity where others saw fear, and they moved accordingly, quietly, strategically, and ahead of the crowd. Trade wars do not destroy value evenly. They distort it. And distortion is where large investors thrive. This is the first hook to lock into your mind. When uncertainty rises, prices disconnect from fundamentals. And when that gap appears, institutions step in. During the trade war, tariffs created fear across global markets, especially around Chinese companies exposed to exports, technology supply chains, and cross-border trade. Share prices fell not because businesses stopped functioning, but because confidence temporarily broke. For individual investors, this environment felt toxic. For major financial institutions, it felt like a clearance sale on scale. Valuations are not emotional instruments. They are mathematical reflections of future cash flow discounted by perceived risk. Tariffs increased the risk premium, pushing valuations lower even when long-term revenue potential remained intact. This is where experience separates reaction from strategy. BlackRock, J.P. Morgan, and Goldman Sachs understood that tariffs were policy tools, not permanent economic laws. They had expiration dates, negotiation paths, and political limits. When risk is temporary but price reductions are immediate, capital with patience gains advantage. Another powerful hook lies in liquidity asymmetry. During periods of stress, smaller investors rush to exit, while large institutions have the balance sheets to absorb shock. Trade war uncertainty forced many funds and retail investors to sell Chinese assets to reduce exposure. This selling pressure created oversupply in the market. Prices dropped faster than fundamentals deteriorated. Institutional investors stepped in as buyers of last resort, accumulating positions quietly while headlines remain negative. This is not speculation. This is structural positioning. The trade war also amplified sector-specific mispricing. Export-oriented firms were punished alongside domestically focused companies that had limited exposure to tariffs. Technology firms investing in long-term innovation were priced as if growth had ended permanently. Financial institutions recognized this disconnect. They analyzed revenue composition, supply chain flexibility, and government support. Where the market saw China risk, they saw differentiated business models trading below intrinsic value. Currency dynamics added another layer of valuation opportunity. Trade tensions weakened the Chinese currency at various points, further reducing the dollar-based cost of acquiring Chinese assets. For global investors operating in dollars, this effectively created a double discount. Lower equity prices, combined with favorable exchange rates, amplified expected long-term returns. This window does not stay open long. When uncertainty fades, currencies stabilize and valuations re-rate upward. Institutions move before that normalization occurs. There is also a behavioral hook most people ignore. Markets overreact to conflict because fear spreads faster than data. Trade wars dominate headlines because conflict sells. Fundamentals change slowly. Institutions understand this psychological gap. They wait for panic to peak, then deploy capital when narrative and reality are farthest apart. This is not timing the market. It is reading human behavior at scale. Perhaps the most important insight is that valuation dislocations reward conviction backed by research. These firms were not betting blindly on China. They were buying specific assets, businesses, and sectors with clear policy alignment, domestic demand support, and long-term earnings visibility. Tariffs created noise, but noise does not erase factories, consumers, or innovation pipelines. By entering at depressed valuations, institutions locked in asymmetric upside, where downside was limited by real assets and upside expanded as fear eventually dissolved. This is how trade wars quietly transfer ownership, not from one nation to another, but from emotional hands to strategic ones. When markets appear to be closing doors, the smartest investors look for the ones quietly opening. This is the first hook to understand. During the height of the trade war, many assumed China would retreat inward and shield its financial system. What actually happened was more strategic and far more calculated. China accelerated financial market liberalization, not as a concession, but as a controlled invitation to global capital. While headlines focused on tariffs, regulations were being rewritten, ownership caps were lifted, and access was being granted to institutions that had waited decades for this moment. For global financial giants, access matters more than sentiment. For years, China's capital markets were partially closed, tightly regulated, and difficult to navigate for foreign players. During the trade war, Beijing recognized a critical reality. If trade channels faced friction, capital channels had to be strengthened. Opening bond markets, expanding equity connect programs, and allowing foreign firms majority ownership in securities, asset management, and futures businesses sent a powerful signal. China was not isolating. It was integrating on its own terms. This shift created a rare alignment of opportunity and timing. BlackRock became the first foreign-owned mutual fund company in China. JP Morgan and Goldman Sachs increased their stakes and operational control within Chinese financial ventures. These were not symbolic moves. They represented permanent infrastructure inside the world's second-largest economy. Institutions do not build bridges unless they expect traffic for decades. Liberalization turned theoretical exposure into operational reality. Another hook lies in market depth and scale. China's bond market became the second largest in the world, yet foreign participation remained relatively low compared to developed markets. As access expanded, this imbalance presented enormous inflow potential. For institutional investors managing trillions, even small percentage allocations translated into massive capital movement. Inclusion of Chinese bonds and equities into global indices forced passive and active funds alike to participate. Liberalization did not just invite capital. It structurally embedded China into global portfolios. Transparency and regulatory evolution also played a role. While concerns remained, Reporting standards, data availability, and regulatory coordination improved significantly. China understood that global capital demands visibility and rule-based frameworks. Incremental reforms reduced friction for foreign institutions accustomed to compliance-heavy environments. As confidence in access mechanisms grew, perceived risk declined. This shift transformed China from an optional allocation into a strategic necessity. There is a deeper strategic layer most people overlook. By opening financial markets during a trade conflict, China diversified its economic dependencies. Trade can be weaponized. Capital integration is harder to unwind. When global institutions have ownership operations and exposure inside an economy, economic ties become multidimensional. This mutual dependency creates stability beyond trade volumes. Financial integration became a form of economic insulation. For institutions, this was a moment of asymmetric advantage. Early movers gained regulatory familiarity, local partnerships, and brand credibility before the field crowded. Access during transition periods carries risk, but also grants influence. These firms position themselves not just as investors, but as participants in China's financial architecture. That distinction matters because participation creates insight, and insight creates edge. What looked to many like a risky opening was to institutions a controlled evolution with long-term payoff. Capital followed access followed reform, and reform followed strategic necessity. While the world debated tariffs, the foundations of financial integration were being laid quietly and deliberately. When uncertainty concentrates in one system, intelligent capital looks for balance elsewhere. This is the first hook. During the trade war, the United States was not just facing external conflict, it was experiencing internal volatility. Policy direction shifted rapidly, political polarization intensified, and markets reacted sharply to every statement, tweet, and negotiation update. For institutions managing trillions, concentration risk was no longer theoretical. It was measurable. Diversification was no longer a choice. It became a necessity. U.S. markets during this period were highly sensitive to political signals. Equity indices swung on rhetoric rather than earnings. Interest rate expectations changed abruptly as trade tensions threatened growth and forced central bank responses. For long-term investors, this environment introduced correlation risk, where assets that normally behaved independently began moving together. When diversification breaks down inside a single market, capital must look outward to restore balance. China offered a different risk profile. Its economic cycle, policy tools, and market drivers operated independently from U.S. political dynamics. This lack of synchronization made Chinese assets valuable from a portfolio construction perspective. Even when returns were similar, correlation mattered more. Institutional investors seek assets that behave differently under stress. China provided exposure to an economy driven by domestic policy planning, internal consumption, and state-guided investment rather than election cycles. Another hook lies in monetary policy divergence. While the U.S. faced pressure to cut rates and manage inflation, trade disruptions, and fiscal uncertainty, China retained greater control over liquidity, credit expansion, and targeted stimulus. This autonomy allowed Chinese authorities to stabilize growth in specific sectors without triggering system-wide volatility. For bond investors, especially, this policy flexibility created a stabilizing counterweight to U.S. rate uncertainty. Currency exposure also played a strategic role. Holding assets denominated in different currencies reduces dependence on the dollar and hedges against shifts in global monetary conditions. During periods of U.S. fiscal expansion and rising debt concerns, diversification away from dollar-centric exposure became increasingly attractive. Chinese assets provided an alternative reserve exposure without abandoning scale or liquidity. This was not about replacing the dollar. It was about reducing single currency dominance within portfolios. Geopolitical risk itself encouraged diversification. Concentrating assets in one jurisdiction exposes investors to regulatory, political, and policy shocks that can materialize suddenly. Trade war rhetoric highlighted how quickly access, rules, tariffs, or sanctions could change. By increasing exposure to China, institutions reduced the probability that a single policy decision in Washington could disrupt entire portfolios. Risk management at this level is not about avoiding risk. It is about distributing it intelligently. There is also a psychological hook worth noting. Markets tend to overestimate familiar risk and underestimate unfamiliar opportunity. US-based investors were deeply familiar with domestic political drama and increasingly sensitive to its market impact. China represented complexity, but also distance from that emotional noise. Institutions with global research capabilities could analyze Chinese risk objectively rather than emotionally. This analytical distance improved decision-making. What emerged was not a bet against the United States, but a recalibration of exposure. Diversification into China allowed institutions to smooth volatility, enhance resilience, and protect long-term capital. In periods of uncertainty, the goal is not maximum return, but controlled continuity. Capital that survives turbulence emerges stronger when stability returns. By allocating to China during the trade war, institutions were not escaping risk. They were redesigning it. Short-term shocks dominate headlines, but they rarely define history. This is the first hook to internalize. Institutional investors are trained to separate what is loud from what is lasting. During the trade war, daily news cycles created the illusion of permanent disruption, yet structural forces beneath the surface remained largely intact. BlackRock, JP Morgan, and Goldman Sachs were not investing in the next quarter. They were positioning for the next generation of growth. Structural growth is built on foundations that do not disappear because of policy disputes. China's infrastructure base, industrial capacity, logistics networks, and technological momentum represented decades of accumulated capital. These assets do not vanish when tariffs rise. They continue to produce value, adapt, and compound. Institutions understand that economies with deep physical and human capital tend to absorb shocks rather than collapse under them. Another powerful hook lies in adaptability. Temporary shocks often accelerate structural transformation. The trade war pushed China to invest aggressively in domestic innovation, supply chain resilience, and technology independence. What many interpreted as weakness, institutions recognized as forced evolution. Economies that adapt under pressure often emerge stronger. Investors who enter during transition phases capture upside from that adaptation curve. Long-term investors also prioritize earnings durability over short-term volatility. Daily price swings matter little when future cash flows remain credible. Institutions model scenarios across decades, incorporating policy shifts, demographic trends, and technological adoption. When those models consistently show expanding domestic consumption, urbanization, and productivity, growth, temporary disruptions become noise. Trade wars are episodic. Structural demand is persistent. Time horizon is the true competitive advantage. Most market participants operate on quarterly or annual performance metrics. Institutions with patient capital can tolerate interim volatility in exchange for long-duration returns. During the trade war, fear shortened time horizons across markets. This compression allowed long-term investors to acquire assets from those unwilling or unable to wait. Ownership transferred from impatient hands to strategic ones. Policy continuity also reinforced structural confidence. While tactics changed, China's long-term objectives remained consistent. Industrial upgrading, financial deepening, technological leadership, and consumption-driven growth continued regardless of external pressure. For investors, consistency reduces uncertainty. Even when growth slowed, direction remains stable. Markets can price slowdowns. They struggle with unpredictability. China offered direction in a world filled with shifting narratives. There is also a behavioral hook that often goes unnoticed. Humans overweight recent events and underweight long-term trends. Institutions are designed to counter this bias. They employ historical data, comparative analysis, and cross-cycle evaluation to avoid being trapped by recency. Trade wars feel unprecedented when they occur, but history shows repeated cycles of protectionism followed by normalization. Structural growth paths tend to reassert themselves. Perhaps the most important insight is that institutions invest where future relevance is unavoidable. China's integration into global supply chains, consumer markets, and financial systems reached a scale that made disengagement impractical. Participation became less a choice and more a requirement for globally diversified portfolios. Temporary shocks did not change that reality. They merely altered entry points. By focusing on structure, rather than shock, institutions aligned capital with inevitability. They did not predict the exact outcome of negotiations. They did not need to. They invested in the trajectory that extended beyond them.